Hello class, in this video, we're going to talk about the definition of current liabilities. So when we talk about current liabilities, let's stop for a while and think about the characteristics of a bigger category, liabilities. What is the first example that come into your mind? Probably loan or notes, right? These are the most common obligations or type of liabilities. And that represents that we're going to pay cash in the future. And then the amount as well as the timing of this paying cash are specified in a legally enforceable contract, right? However, if we're going to define liabilities, this obligation, this liability, it does not need to be payable in cash. In other words, it doesn't have to be in cash, meaning that it may require the company to transfer other assets or to provide services. A liability also doesn't have to be represented in a written agreement. It also doesn't have to be legally enforceable. Even the amount and timing of the repayment, it does not need to be precisely known. But so from financial reporting perspective, how do we define liabilities? Well, it usually has three essential characteristics. Liabilities are, number one, probable future sacrifices of economic benefits. Number two, liabilities arise from present obligations. It is an obligation to other entities. Number three, liabilities result from the past transactions or events. Note that the definition of a liability involved future, present, and the past. Well, it actually is a present responsibility. And it means we're going to sacrifice assets in the future because of a transaction or other event that happened in the past. All right. Now, in this chapter, we're going to focus on current liabilities. Then how about the definition of the current one, right? In a classified balance sheet, we categorize liabilities as either current liability or long-term liabilities. We often categorize these current liabilities as obligations payable within 1 year from the balance sheet date, or within the firm's operating cycle, right? Whichever is longer. Now, this is a general definition and it usually applies. However, we can also define it with a more discriminating definition, which is this current liability usually are those expected to be satisfied from current assets, which means we are probably going to use our current asset to pay back or to satisfy the current liabilities. It can also make possible by using the creation of other current liabilities. Now, the current liability examples or the most common current liabilities are the following. We have accounts payable, notes payable. These two are pretty familiar, right? And then we have commercial paper, income tax liabilities, dividends payable, as well as accrued liabilities. We're going to go over those six one by one. But in this video, we're going to focus first on, the obligations to the suppliers. And these can be either accounts payable or trade notes payable. What is trade notes payable? Notes payable can be related to trade or not related to trade. Trade notes payable, meaning those payable that are related to suppliers, right? Now, first, let's look at accounts payable. Well, these two are good. And then accounts payable are obligations to suppliers of the merchandise, or, maybe somebody provided service to us and they are also our suppliers, right? and we purchase this inventory or we purchase some service on an open account, which means we purchase on account, right? Most trade credit is also offered on an account. This means that the only formal credit instrument is the invoice. We don't have any contract, just the invoice, because the time until payment usually is short. Remember the 210 net 30, right? So paying back accounts payable is usually short, oftentimes 30 days, 46, 45 days, or 2 months, which is 60 days. These liabilities typically are non-interest bearing and are reported at their face value. Of course, it's really short. The key accounting consideration for these accounts payable are determining their existence and ensuring that they are recorded in the appropriate accounting period. Next, we have trade notes payable. This differ from accounts payable in that, number one, they are formally recognized in a written promissory note. So whenever we see note payable, it must be formally written. So there is a contract. It's no longer just the invoice. Often these are a somewhat longer term. It's not just up to 60 days. And, it oftentimes bear interest, right? We have a midterm question asking the difference between accounts payable and notes payable interest. Now, let's use a current liability section of the balance sheets of General Mills and the related disclosure notes in the next slide to provide some perspective. General Mills presentation and supplemental footnotes are fairly typical. So as you can see here, the accounts payable in 2017, which is listed as the first line, it is a 2,100 19.8 million. And the notes payable is this part, also under current liabilities. We have 1,234.1 million. Okay, so what is in the disclosure of General Mills? Well, the note 8 is about the debt, and in it you see a notes payable section. Basically, it lists out all General Mills notes and their respective weighted average interest rate. So what type of notes does General Mills have? Two. Number one, they have this US commercial paper. So this is not about trade related, right? And two is the financial institutions. So they have two notes payable. And the face amount is listed as note payable. Then you have the weighted average interest rate. So these are the interest rates stated. You see that the amounts are different. So when we weighted it out, you see the total note payable is the amount that we see, right? 1,234.1 in the previous table. But the interest rate is a weighted average between these two. They also listed the 2016 as comparison. Well, to ensure the availability of funds, General Mills also maintain a bank credit line sufficient to cover the outstanding notes payable. So here they listed the dollar amount, right? The following table details the fee paid to committed and uncommitted credit lines they have. So these are the fees they paid for the credit lines in order to maintain the notes payable. What are credit lines? We're gonna define it in the next few slides, but generally they're gonna disclose also the credit lines and the fees they pay right next to the notes. So a concept tract about current liabilities. You can pause here and do it yourself. The correct answer is D. So all the following above statements are true for concerning the current liabilities. So we have defined the current liabilities. Next, we're going to talk about the short-term note payable. I'll see you in the next video.